A warm good afternoon to all. I welcome Dr. Rahul Sharma to deliver this session, first session on Financial and Management Accounting for Online Program, MBA. Dr. Rahul sir, you can start your session now, sir. Thank you.
Good afternoon, all of you. It's glad to have you part of this class of the online MBA program. I'm Rahul Sharma. I have been associated with Manipal University from almost last 7 years. I've got my total experience of around 15 years of academics, and I've done become honors in accounting. In addition to that, I've done an MBA, and I'm a CMA, Certified Management Accountant, and a CIA as well, that is Certified Internal Auditor. I welcome you all for this class, and I hope that we would like to make this session more interactive and more discussion. So whatever doubts you have, you can have it after the class. We can discuss, and we will feel free to ask whatever queries you feel after this. Right. So we start with the first class of accounting and financial management. The subject is related to somewhat, a part is related to accounting and a part is related to financial management. So today we'll have a basic introduction class, and then we'll take it further for the next sessions. So to start with, what we'll do today, we'll have a basic introduction of accounting, financial accounting, and we'll move to the basic terminologies. There's some differences between bookkeeping, accounting, and accountancy. Then we'll move to users. What are the users of accounting? Who all are the users? And then we'll move to the limitations and advantages, and then we'll end up with some terminology, basic terminology related to accounting, which we'll use day in, day out throughout the sessions. So to start with, what is accounting? We say accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transaction, and events, which are, in part at least, of a financial character, and interpreting the results thereof. So we have, when we say accounting actually, I believe many of you would be dealing in these particular accounting processes or would have had an idea about accounting. So accounting, what we do actually in accounting is kind of we record the transactions, we classify them, and we try to summarize them in a relevant manner, in a manner which is significant to all of us, right? In a manner which makes it fruitful, which helps people to take decisions and come up with their outcomes. So, and we record the transactions and events which are of financial character, and then we interpret the results. So what we have planned today and what we'll be aiming for, the concepts and process of financial accounting. We'll try to understand the differences between bookkeeping and accounting and accountancy. Then we'll move to the users of accounting, who all are the different users of accounting, and how we can categorize them. And then we'll close with the basic terminologies related to accounting. So accounting as an information system is the process of identifying, measuring, and communicating the economic information of an organization to its users who need the information for decision making. So we have people who anxiously wait for the company's results. There can be a management, it can be a company's employees, it can be regulatory authorities, it can be general public, it can be lenders, it can be creditors. There are a number of people who are associated with it, right? So they people actually, they are the ones who use this information. So, and they take some decisions based on that. So what accounting does, accounting actually provides that kind of that information to these users so that they can take their decisions and they can come up with what decisions they want. So to brief out, we can say that accounting is an information system. Yes, it's an information system. It provides information to users for different decisions which they want to make. Then it's the process of identifying, measuring, and communicating economic information. So we identify, we measure, and we communicate economic information to the users. Then information provided by accounting is used by the users for decision making. So we have an information system which provides us information, and that information is used for various decision makings. We move next. Then we talk about objectives of financial accounting. So what are the objectives? Why do we need financial accounting? What are the requirements of financial accounting? So financial accounting is basically used for these objectives. First is to keep systematic record. So accounting, see, whatever a business does in a particular period of time, accounting basically keeps a track. It keeps a record that what the business has done, how much, let's say how much what we have sold, how much we have purchased, what expenses we have done in salaries, what expenses we have done in wages, how much machinery we have bought, how much land have we bought, how much furniture have we bought. So we need a proper record, we need a proper system to record all these things. And who records what? There's the process which records all these things, or the function which actually keeps a track of all these things, that is actually called accounting. So the first thing accounting actually helps us is to keep a systematic record. Second, we would like to know next that what would any management or any owner, any stakeholders of the business would like to know that how the business is doing. Is business is running in profit or business is running in loss? So every stakeholder would like to know that how that business is going on. So if the business is running in profit, they will have new plans, they will have new ventures, they will have new ideas to grow it further. If the business is running in losses, they can have further plans to enhance the performance or to make it better. So accounting again helps us in finding out that the business is running in profits or it is in losses. We move next. It helps us to ascertain the financial position of the business. So the financial position of the business is different from the profit. So I may be in profit, but I may be in a financial distress, or I may be in a loss, but financially I may be sound. So these are different nitty-gritties of accounting which will take further. So what happens in this particular case, when we talk about the financial position, we talk about the debt paying capacity of the business. Debt paying capacity in short run as well as in long run. So how the business is business financially sound? Can business make the payments on time? Can business meet the obligations? So we look for all these aspects, and accounting again helps us in finding out that what is the liquidity position of the company and how is it going. Then we move next, we talk about the liquidity positions. So that is again something which we discussed in the last point, again related to that only. So we can figure out that what my positions are, can I pay my debts and obligations on time and not. And then to protect business properties. So accounting actually helps you in getting the claim on the certain business properties of the business, right? So what all business properties you have, what properties you own, what claim you have, what payments have you done, what payments are pending. So what helps us in all that? Accounting actually helps us in keeping the records of all these things. So these are the objectives of financial accounting. We move to the accounting process. Now how does accounting process looks like? So accounting process is have something like identifying. So what I do, I identify. And what do I identify? I identify the transactions. I identify what needs to be recorded. I identify what can be recorded in my books. So, and as we have discussed in definition, we can only record monetary aspects, or we can record only those things which can be measured in terms of money. So that's why the first thing what we do is we identify the transactions which can be recorded. Next, we move to measuring. By measuring, we mean how much money has been involved, how much amount of money is actually involved in this, and how much money am I paying, how much total money do I have to record. Let's say I bought a furniture, so I know that I bought a furniture, I need to record it. But how much amount should I record for that furniture? Shall I record 1,000 rupees for a chair, or shall I record 10,000 rupees for a table, or shall I record 50,000 rupees for a whole furniture set which I bought for my office? So that decisions need to be taken. So that is what we say with measuring. So we measure that how much to record and what amount to record in this particular process or in accounting, in the books of accounts. We move next, we do the next step, we record. So we record, fine. So let's say I have a firm, I bought a furniture. So I bought a furniture for 20,000 rupees. So I said, fine, I recorded 20,000 worth of furniture in my books. Now moving next, once I have recorded that, fine, I have bought, so I have identified this, yes, I bought furniture, I did a financial transaction, I measured, yes, it involves 20,000 bucks for this. Then the recording, so I need to record the amount of the transaction, so I recorded that, fine, this is what the transaction I have done. I move next, then I kind of categorize them, so I classify. So let's say, fine, this actually belongs to my, which category does it falls into? Does it falls into the sales? Does it fall into purchase? Does it falls into the sale of purchase of fixed assets, or does it fall into the sale of goods? So I need to classify these two things. I need to classify I need to categorize them into different we can say categories, or in different baskets, right? Once classified, I need to summarize. So I summarize. So I have a long transaction with me. So let's say I bought furniture of 20,000 on this and this date. So I need to summarize this. I need to put it in short form. So how can I summarize? How can I actually put it into short form? So I do some entries and kind of some sort of summarized form of those particular transactions. Then we analyze. So once we go for the summary, after summarizing, we go for analysis, and we analyze that how the business, what we have done. Have we done profit or loss? Have we ended up into the kind of a transactions, or what we have done in the business, has that resulted into a profit for the whole year, or that has resulted into loss for the whole year, or where do we stand in respect to the liquidity, positions of a business, and all those aspects in related to the for the business. Then we try to interpret. So once we have analyzed, then we try to interpret the process, the accounting information which we have marked, which we have recorded, classified in our books, and then finally we communicate. So we communicate the whatever we have done in the whole year. So our performance as a books of accounts, maybe as a balance sheet, or a profit and loss account, or cash flow statements, is being communicated to the people, to the relevant users. And who all are the relevant users? We'll have a look into the coming slides that who all are relevant users. So we communicate, so this is what the process of accounting is. We identify, measure, record, classify, summarize, analyze, interpret, and communicate the accounting information. We move next, and then there is something which is relevant to accounting, and which is a part of accounting itself. We call it bookkeeping. So people often get confused that what is bookkeeping and what is accounting. So bookkeeping, yes, we can say it's a part of accounting, but yes, it is considered as a different branch. So we say up to recording, right? So it is related to how to record the business transactions, right? And it is often, we can say, it's routine and clerical in nature. So when I record my transactions up to the recording process, that is called bookkeeping, and we say it's often routine and clerical in nature. We move next, and we talk about functions of bookkeeping. So what are the functions of bookkeeping? So bookkeeping, first, it records the transaction in journal. So we have some books in accounting. We have a journal books, ledger books, and all those things. So in journal, we first record the transactions. So bookkeeping actually record the transactions in journal. Then we post the transactions in ledger. So once we have transactions in journal, we post them in ledger. So once we post them in ledger, it's like we have ledger accounts in business, and ledger accounts, what we call in accounting, is there are different accounts for different heads, classifications, what we were talking about. So let's say you have a fixed asset, so you'll have a fixed asset account, and as we purchase the furniture, I give an example of furniture which we purchased for 20,000 bucks. So that was actually related to furniture. So I'll have an account which will be classified as furniture account. There I'll show that I have bought a furniture of 20,000. amount, and that furniture account would be called as ledger account. So we have ledger accounts as such for all those transactions which we have into the business, which we have into the operations, right? Then we balance the accounts. So whatever we have done, how much furniture have I purchased, how much sales have I done, how much money I have collected from my customers, how much machinery have I bought, how much raw material did I bought, all those things are being taken care of, and we end of the day balance our accounts with the help of bookkeeping, or that is called as bookkeeping. We move next, and then we move to the next topic, which is between difference between bookkeeping and accounting. So when we talk about bookkeeping and accounting, there are some difference related to that. So the first difference which comes in related to bookkeeping and accounting is scope. So the scope of bookkeeping and accounting says that bookkeeping actually has a very basic things involved. So it has a very narrow scope as such. As we discussed, bookkeeping is related to the part of recording the transactions and balancing the journal. But when we talk about accounting is somewhat broader than bookkeeping. So we have a bookkeeping up to the recording, but accounting starts after bookkeeping is being done. Right? We move next. Next is stage. So bookkeeping is considered at a very primary stage, right? So we say bookkeeping is at a very primary stage of the process, right? And accounting is considered on the secondary stage of the process. So it is on the later part of the process where accounting comes and has its role, right? Then we move next. We talk about objectives. So we have objective. So what is the objective of bookkeeping? So the objective of bookkeeping is to maintain the systematic records. That is the objective of bookkeeping. But what is the objective of accounting, right? So the objective of accounting is to ascertain the net result or the net position of the business. That is the objective of accounting. We move next. We have nature. So the nature of bookkeeping, as we discussed, it is often routine and it is clerical in nature. That's what we discussed when we were talking about functions of bookkeeping, right? And when we talk about accounting is analytical in nature. So you have a kind of a analysis type of things which comes into the accounting, and you go for that. We move next, and then again continuing with the difference between bookkeeping and accounting. The next thing is responsibility. So who is responsible for bookkeeping and who is responsible for accounting? So we say a bookkeeper is responsible for recording business transactions. So there is a category, or there's a group of people whom we call bookkeepers, or a job related to bookkeeping is there, and they are the people who are responsible for keeping the books of that particular organization. Then we talk about accounting. So who is responsible for accounting? So an accountant is responsible for the work of bookkeeper. So when it comes to the bookkeeper, he is responsible for recording business transaction. But when it comes to the accountant is actually responsible for the work of bookkeeper as well. Right? Then we move next. We talk about supervision. So who has the supervision of whom? So the bookkeeper, he cannot supervise and check the work of accountant, as bookkeeper is at the primary stage, accountant is at the secondary stage. But accountant, yes, he has all the rights and he can supervise and check the work of bookkeeper. Now next, and then we have the last point, that is staff involved. So when we talk about staff, so the staff involved for bookkeeping is mostly a junior staff of the organization. And when you go to the accounting, it's the senior staff which works in accounting functions or in accounting. So this was related to difference between bookkeeping and accounting. We move to the next slide and we talk about users of accounting information. And when we talk about users of accounting informations, the users of accounting information can be broadly classified into two main categories. And when we talk about those two categories, they are First internal users and the next is external users. So there are people who are considered, or a category of people who are considered as internal users, and there are a category of persons who are considered as external users. So who are internal users? Internal users would be the people, would be the group of persons, the category of persons who are actually who are a part of the organization. So that is the basic line we can draw for the internal and external users. And when we talk about external users are the people who are related to organization, but they are external. They are actually related to organization in an indirect way, but they are not directly related to the organization. So let's say somebody who sells goods to the organization, so is he an internal, will we call him an internal user? No, we cannot call him internal user, because he is not a part of organization. So what do we call him? We call him external user, as he is outside the organization, but he has a concern with the organization. He whatever happens in an organization has an impact on him. It impacts his business, it impacts his future growth, it impacts his prospects as well. So that's where the external users can be classified like that, the people who are indirectly related with the organization but not are in the organization. So to know more about internal users, let's have a view who all can be called as internal users. So when we talk about internal users, so we have a types of internal users. The first one is management. So the the management is the one for whom the records or the business performance is very important. They are the people who handle the business day in, day out, and they would be concerned about what my business is doing, how we have done, how our decisions have impacted us, have we been in profit or have we been in losses, how would it be to continue with the steps we have taken this year for the next year as well, shall we continue with our plans or shall we need to check our plans and go ahead. So management as a user requires this information for every decisions what they have taken, to know how they are performing, to know how business is growing, to know how the things have moved up. So that's where the management becomes a very important user of this particular information that is called accounting. We move next. Then we have employees and trade unions. I believe most of you will be working in your organizations, and if you see as an employee, you would be very much interested in knowing that how your company is doing, how your company has performed. If your company is performing good, you would be very happy in figuring out that fine, next year I'll have a bonus, or I'll have some increment in my salary, or I can have a promotion, I have a growth chances in future. But if your company is not performing good, then again you have a choice that fine, whatever I am doing is worth doing or not worth doing. Shall I continue with the job with the current company at the current organization where I am in, or am I supposed to move out? It's done. I don't see any growth. I don't see any future in this company because there is some problem with the operations. The company is not doing good. The profits are not working out. So there may be problems. So that's where the employees and trade unions they have a role. So trade unions, they are very much interested about knowing the rules and regulations being followed by the company related to employees welfare. Are they giving due benefits to the employees or not? So these are the broad two categories which can be classified as internal users. We move next. When we talk about external users, and when we talk about external users, the first and very important external user is investors, security analysts, and portfolio managers. These are the people who day in, day out put their money, or ask people, suggest people, advise people to put their money into certain organizations or certain business houses, and then they are like They keep an watch on every company's results and outcomes, how the company is doing. And if they find that yes, company is worth investing, they suggest to their investors or the people who are taking their advices that fine, you go ahead and invest into this particular company. But if they find no, there is no sense, company is making huge losses and there may be problems with this company in future, they may right away suggest not to go ahead with that company and may ask investors to withdraw their money out of from their investment. So that's where the investors, security analysts, and portfolio managers, they play a role. So and once they the indirect contribution what they have a contribution in increasing the value of the company as well. So if your company if like they suggest people to buy shares, the demand of the shares of those company will increase, and end of the day, if the shares demand will increase, we all know the rule of supply and demand. So if the demand will increase, the price of that particular shares will also increase, end of the day, which will result in increasing the wealth of shareholders, and they are again the owners of that company. So that's how these people have an indirect role in increasing the wealth of shareholders of that particular company, or in the other way we can say increasing the valuation of the company as well. Well, next we have lenders. And when we talk about lenders, we all know lenders are the institutions or people or organizations who have lended us money. So the organizations who have lended us money, they are considered as a part of lender. They can be a prospective lender as well, who is planning to give you money or who is planning to lend you money, but again is in dilemma that shall I go ahead with the funding for this business or shall I not? So the lender would be anyway interested in knowing that would business be able to repay its debt or not. I'm paying this. Let's say I'm paying a business 500 crores right now, but this business has a capacity to pay 500 crores later on? Will it be able to pay this money back? Can they do it? That's what the lenders have to look for. That's what the lenders actually try to figure out, that what would be the repaying capacity or repaying position of this business, of this company in future. Next, we have creditors. We have different types of creditors. We'll move into that detail later on. But creditors are the category of people whom we have to pay money, who actually whom we need to repay. We have taken some services or certain goods or certain money from them, and we need to repay them. So that's what the creditors are. So we have done some purchases where we have not paid money to them, so we need to pay. Those are creditors. And creditors as a user would always be interested in the business information, because whenever they supply a certain product or a certain goods to the company, they have always have a worry in mind that would I be able to get my money back from this company or not. And imagine you paying something or to somebody on debt, on credit. That's fine, you take this goods from me or you take this thing from me and give me the required amount later in future. How much worried you would be, how much worried any of us would be for this particular thing. Your money is involved, the stake is there, you need to get it back. That's what can be done with that. That's what and how you can figure out. You cannot predict future, but you can just satisfy yourself that how the things have been going, and that only accounting information can help you in figuring out that should you actually go for continue as a creditor, or should you actually give to this business something on credit or not, right? So we move next. Then we have customers. Customers as a individual will always be interested in knowing how their company is doing. So if the company is doing good, customers will be happy to be associated with that company. If the company doesn't do good, if they're not following good practices, they are not having good profits and good business prospects, the customers may lose interest and they may feel like that there is no sense continuing with this organization, and they may feel like to get detached from this particular from the organization. We have next, that is government and regulatory authorities. So when we talk about government and regulatory authorities, it's all your financial controllers, your security controllers, your company's registrar, all those come and have a play, they have a role. So government and regulatory authorities, your taxations department, they will have a say into this. They would like to see how the organization is doing into taxation. Have they filled in the required documents? Have they filled in appropriate manner? Right? Are they following all the rules and regulations? They might, I mean, they would like to know that the company is not has not breached any legal regulations and compliances. So that's what where the government and regulatory authorities, they have a role, and they are always interested in knowing the outcome of the business or knowing the results of the business. Then the next we have public. Public is the one who is impacted by who is always impacted by the business. So the business uses resources from the public. They have the society where they serve, so they have that society upliftment which they do. So if the business does good, public always has a good indications of good prospects for the future, or they can have a good idea about future, that fine, that the businesses will do good. I mean, and there are chances of growth, there are chances of better prospects, the societal upliftment can be done. And if the business is not doing good, the public might lose interest. They might feel like that this is something which is not going to survive for further. So any decisions what they're taking, they can change those decisions and look further for the new avenues or new decisions or new investments, right? We move next. Then after internal and external users, we move to advantages of accounting. So what are the advantages of accounting? So if you look onto the advantages of accounting, the first is complete record. Accounting gives me a complete record of business throughout the year. So it can be for any period. It can be for a week, it can be for a month, 2 months, 6 months, 8 months, 9 months, for any year. But for whatever period I'm preparing my accounts, it gives me a complete record. I move next. Then information about profit and loss. So accounting gives me information about the profit and loss of the business. So my business is into profit or is into losses. Accounting actually helps me in identifying that and helps me in better decision making with the help of that. So whatever profit and loss or howsoever the business is doing, accounting actually helps us in decision making. It provides us the raw data, or it provides us the information for that particular decision making. Comparability. If I have to compare my accounts with, let's say, my with the past year's accounts, or if I have to compare my accounts with some other business, the accounting provides me that comparability. I can use that accounting process or accounting methodology to compare the business performance of this year with the last year, or of the same business with some other business. So that's where accounting helps me in comparing the businesses and make it useful for us to assess that the business has done better or business has not done better in compared to the last year or in comparison to the other businesses. Next, the management performance. So all your CEOs, CFOs, the C-level authorities, their performance, their future growth, their prospects depends on how the management has performed, how the business has performed. So their business has been done well, has done great, or the business has drastically failed. So if the business has done great, yes, the management will have a benefit of that. They will have the incentives, they will have the advantages of that. But if the business has not done well, business has been into loss, the management has to bear the brunt as well. So they will have a problems in future, they will have a problems in their incentives, they will have a problem in their future association with the organization as well. So there are different scenarios where it can be advantageous for the accounting where accounting can actually help us in assessing the management performance. We move next, and then it provides relevant information to users. So accounting actually provides, as we've discussed, we have internal users and we have external users. And we saw that what are the different types of internal users and different type of external users we have into business. So what accounting does, accounting provides the information to these users. And why do they need that information? They need that information to get the to take their decisions, to for the better decision making. Then we move next and we talk about limitations of accounting. So what are the limitations of accounting? So as everything, every coin has two sides, the positive and negative. Same way accounting has also got its pros and cons. So accounting has its own limitations. So when we start with the limitations, so the first one is it measures only monetary transactions. How good your management are, how skillful your people are, how dedicated your workforce is, those all things are not being taken care in accounting till now. So that's where accounting actually lacks, that it doesn't have, it can measure only those things which can be monetary, which for which it is possible to have monetary measurement. Otherwise accounting cannot do that. They cannot measure all those things which cannot be measured monetarily or in terms of money. We move next. Accounting is historical in nature. Yes, there is a problem with accounting. It's historical in nature. So if I bought a machinery 5 years back for 50 lakh amount, so that would be 50 lakh for me still. So there would the gross value of that would be showing that 50 lakh, and then I'll be charging depreciation on that. So that's where, so it is actually shows historical values only. So it is based on historical concept. We move next. It's not free from bias. No, it's not. I mean, the people who are actually involved in the accounting functions these days, they would be aware that it is not free from bias. End of the day, it's the management's, it's the judgment of accounting head, it's the judgment of management that what rules and regulations do they want to apply, which rules do they want to follow, which method do they want to follow. So they will have for, let's say, there are different methods for different things. There is different method for depreciation, there is a different method for inventory valuation. So there are different methods for different so things. So what method to apply, the discretion lies with the authorities. So how they want to show it, which method do they want to go for. Then it ignores price level changes. That's again something very important. So price level changes, so any changes which have happened maybe due to inflation or anything, or the prices have increased, decreased, accounting doesn't take care of that. So once I've recorded the value of a particular thing, yes, I have recorded, I'll continue my record with that particular value only. So this was about limitations of accounting. So we did advantages and limitations, and we move next. And the next one, there's one more point. It's accounting principles are not static. So yes, the principles keeps on changing. So changing in the sense that it can be changed for the betterment. So this year, if I followed a certain principle, that may not be static. It may change for the next year. So that's where again it creates a confusion. It creates it makes it difficult to decide, because the confidentiality on these data, that actually goes off, that actually lacks. Then we discussed about bookkeeping and accounting, and there is a term which can be related with that, that is accountancy. So we have accountancy, accounting, and bookkeeping. So we learned about the difference between bookkeeping and accounting. Let's try to learn the similarities or the relationship between bookkeeping and accounting and accountancy. So we discussed that bookkeeping, it provides the basis for accounting. So it is at a very primary stage we do bookkeeping, and we discussed that it's the junior staff which actually takes care of bookkeeping. So we have a bookkeeping which provides the basis for accounting, right? But can we go without bookkeeping? Is accounting complete without bookkeeping? No, it's not. It can never be. So accounting requires bookkeeping. So bookkeeping is a part of accounting process and it is complementary to it, right? And we can easily say that accounting actually begins where the bookkeeping ends. So my bookkeeping ends and my accounting starts, or my accounting starts when my bookkeeping ends, right? We discussed about recording the transactions, balancing the accounts, and all those things. So that was related to big bookkeeping. So the moment my bookkeeping ends, my accounting begins. Accountancy includes accounting and bookkeeping. The term accounting and accountancy are used synonymously. So if I'm saying accountancy, so I need not say that bookkeeping. I need not mention bookkeeping separately. I may say accountancy. It involves both accounting and bookkeeping. And when we say when we can use accounting and accountancy synonymously. So that's why when we say accounting, we talk about accounting only. We include bookkeeping and accounting. We don't take a different name for bookkeeping because bookkeeping again is a part of accounting process. Right? So it's considered as a separate field, a part of that. But yes, bookkeeping is a part of accounting process, and accounting cannot go ahead without bookkeeping. Right? We move next. We have a concept which is known in accounting is called as window dressing. So when we talk about window dressing, it's like I want to show a certain, we can say a certain information, or I want to present an information related to my business which actually doesn't exist, right? Or I can abiding the laws, I can try to figure out some loopholes where I can make some changes into my data, into my information, and my users may feel like, may find that this company or this organization is very attractive, but actually it may not. That's what window dressing is. So window dressing is where I'm trying to portray a better picture of my accounting books or of my business. But in reality, does that exist? The answer would be no, that doesn't exist. That's what window dressing is. I'm trying to manipulate within the law, within the framework. So any loopholes I have, I'm trying to mold them in my favor. So how can I do that? There are different ways of doing it. I have certain judgments with me which I can use, and I can provide a better picture than what it is right now, or I can give an improvised version of my data, of my balance sheets, of my financial statements. So let's look at the methods, how I can do it. So the first one is advancing the sales from the next year. So if any sales, see, it can be both ways. Now, if I have done enough sales this year, the organization can actually hold the sales for a duration of 2 or 3 days and can book it next year. So that is how they can actually, because the records, they have to make the records, they have to make the bills, right? That they can do it easily. And similarly, if they have to show the next year's sales in this year, they can do it. But it's not like, that if my accounting year is ending from January to December, let's say 2020, I'll able to show September 2021 sale in that period. No, it doesn't happen like that. What happens is, for a period of 3, 4, 5 days or a week maximum, they can mix the data. They can put the data of next year into this year or the last year's into this year. That can be done, and that is how they can actually manipulate the window. They can do the window dressing. We move next. Other income component. There's a component which is called as other income. So you have a number of things in that, and which may later on you may say that it didn't work out, right? Normally, I tell you, there's one more thing which is called, there's something known as the organizations, they do sales as well, false sales, and then they later on say that it was returned. So for once they have a profit increase in that particular year, but next year that has a problem. So similarly in the other income department, they can include certain items which can be shown as in the other income component, and later on that may work out, that may not work out. So if it doesn't work out, they can easily claim it that it didn't work out, right? So I can claim a rental income coming, all right, but let's say somebody, I can say somebody is paying me rent, it didn't pay me from last 10 months, but still I have earned it, right? That's how accounting works. So if I have earned it, I can show it in my books, but if it doesn't comes up, I'm gone. So that's how. So I can increase my other income with the help of this. I can sell a fixed asset and earn a profit out of that, and that will be included in my final profit. But does that make sense? I mean, selling a fixed asset and earning a profit from that and showing that into as a final profit of the business. So these all things are there, which actually helps in window dressing of a business. Then depreciation method and rate. What rate to follow, what depreciation method to follow, the judgment lies with the accounting function or with the authorities of a business. So they again need to take a call, and whatever method they use, they may decide, that fine, they want to show the higher value of the assets or they want to show the lower value of the assets. Depending on that, they can manage their accounts. Next is inventory valuation methods. There are several inventory valuation methods. So we have a LIFO, we have a FIFO, we have average method, cost method, and all those things. So what method to use and how to apply that, the again discretion lies with the organization. So according to their choice or according to their what they want to come up, they can use any method, FIFO, LIFO, or whatever business method they want to come up with. So that again helps them in window dressing. Then receivables management. I may have great receivables in my book, and I can show you that, see, these I have so many debtors in my book. Can I show that? Yes, I can obviously show that. But I know that half of these debtors are those who will never pay me money, from whom I'll never able to receive money. And if that is the case, intentionally I am showing a wrong picture of my books, wrong picture of my data, wrong information to my users. So when we come to the, we were discussing about transactions. So transaction was when we actually get involved into anything. So either I purchase a fixed asset or I sell something, I pay a salary. So whatever and wherever money is involved, that is something which is called as transaction. Next we have the next thing we have is capital. Capital is any amount which is invested into the business. Now it can be a short term, it can be a long term, it can be an owner's money, it can be borrowed money. So that all can be called as capital. So any amount of money which is invested into business is called as capital. We move next, then we have shares. So when we talk about shares is that we have the owners of the business. So we have equity shares, we have, in some countries we have preference shares, in some we have we call it preferential allotment. So there are different things out there, but yes, share is a part of capital which is divided into small denominations. We call that share. So if you look onto the share, what share is? Share is, yes, it's a the total capital of the company is divided into units of small denominations, and those units of small denominations are called as shares. Next we have assets. So anything what a business owns, any damn thing a business owns. It's a furniture, it's a land, it's a building, it's a vehicle, it's a livestock, anything which business owns, what he has a right to claim, ownership rights, that is actually called as assets. So we call it an asset of a business. So that is assets. Then the assets can be further, we can divide them into certain types. The first one among them is current assets. So when we talk about current assets are actually those assets which meet a certain criteria. So there's a 3-step criteria for a current asset. So if current assets meet any of these 3 criteria, if any asset meets any of these criteria, we call it current asset. So the first criteria, first classification is that either it has to be a cash in hand or cash at bank. So if it's a cash in hand or a cash at bank, yes, we'll call it a current asset. Next is it is convertible to cash within an year or an operating cycle, whichever is longer. So any asset which is convertible to cash within a year or an operating cycle, whichever is longer, is called as current asset. And the next one is the asset will be consumed in the operations of the business. The asset will be consumed in the operations of the business. So if you take an example of raw material is something which gets converted into the finished goods. So by the end of it gets converted into finished goods, raw material actually loses its existence. So that's where raw material comes up. So that is again a part of current asset. Then we have liquid assets. So that is a further category after current assets. And we say liquid assets are actually those assets which are either cash or bank balance or convertible to cash or bank balance within a very short span of time. So that is liquid assets. So any assets which have this criteria, either cash or bank balance or convertible to or cash and hand or cash and bank within a very short period of time, we call them liquid assets. We move next, continuing with the basic terms in accounting, and the next is liability. So if asset is something which we own, liability is something which we have to pay to somebody, which is due to somebody. So any money or any amount which you have to pay someone and which is due to him, which you have not paid, that is your liability. That is something which you owe to them. So, and for the business, there is a concept which we'll study further, which says that even the money which is invested into the business by the owner is also a liability. So, business considers that also as a liability. So, any amount which business takes from the which is due to be repaid or which business owes to somebody else, that is called as liability. Then again, in the same liability section, we have a current liability. And when we talk about current liabilities are those liabilities which are to be repaid within an year. So I have a certain amount, I have certain salary, certain expenses which I have not paid. Maybe my phone bill, maybe my electricity bill, my fuel charges. I have not paid for it, but I need to pay it now. And once I need to pay it now, which is so once I've not paid it, it becomes my current liability, but I have to pay it within an year. So any liability which I am supposed to pay within a year is called as current liability. We move next. Then we have equity. Equity is the claim of shareholders in the business. That is equity. So the whatever is left, the profit or loss, that is equity. So we have a shareholders fund as well as related to this, where we have equity share, preference shares, and all reserves and surplus we apply. So that leads to the equity. Then we move next. We talk about entity. So entity we refer to the organization which is doing a business. So if let's say Mobil Oil is doing a business, so Mobil Oil is an entity for us, right? If Microsoft is doing a business, so Microsoft is an entity for us. So these all are actually called as we call the organizations, we call them entity. Then we move next and we have a sole trader. And when we talk about sole trader is the only person who is doing a business, the only person involved. That is sole trader. So somebody who is doing a business at his own, we call him a sole trader. Nobody involved, no other partnership, nothing. I'm the only person who do everything in my business, and I have no partnership, no shares, no shareholders except me. So that is sole trader, where I'm the only owner of the business. Then partnership, so where it's like where two or more persons they agree to share their profits, we call it partnership. So when two or more persons they agree to share profits for a business and to have a common goal, we call it partnership. Right. We move next, and next we have a joint stock company. So when the shares of the company are actually issued in to others, we call it a joint stock company, right? So when you have several shareholders, we call it joint stock company. Then we have goods, and when we talk about goods, we have goods as we purchase them. So there is purchases. So when we purchase goods, it is called as purchases. When we sell goods, it is called as sales, right? When we return, right, goods, so we can have both. So when you are selling, you can have a return from that. When you are purchasing, you can also return that. So we call it, if we have sold and it has been returned to us, maybe due to any reasons, we call it sales return. The sales which has been returned to us. And when it is like we purchased some goods, we didn't like it, we thought that fine, it's better to return it, we call it purchase return. So when the sales get returned to us, we call it sales return. When the purchases get we return the purchases, we call it purchase return. Then we have opening stock and closing stock. So opening stock is any stock which the business has on the beginning of any period. The period could be a month, it could be a year, it could be a week, it could be a day as well. So let's say today I have a certain opening stock, I sold something, I purchased something, and what is my closing stock today? I can do that. Similarly, I can do it for 6 months, I can do it for 3 months, I can do it for a whole year. Right? Next, we have inventories, and when we talk about inventory is like what I deal in, how much stock do I have, what is it, right? So business for business purposes. So I can have a raw materials. So the inventories again can be in three forms. So I have a raw material, I have work in progress, which is neither raw material nor a finished goods, and I can have a finished goods which is ready for sale. So that is the three kind of inventories what we can have. So I have a raw material inventory which is ready to be processed. Then I have WIP, which is neither a raw material nor a finished goods, it's still in process, and then I have a finished goods. Then drawings is any money which is taken out by the proprietor. It's normally happened in sole proprietorship and partnership firms, so it is not related to companies. But yes, drawings is a terminology which is included in business. So any amount of money which is withdrawn by the proprietor or by the partner of a firm. Then next we have debtors. So debtor is somebody from whom we have to take money. So debtor is somebody from whom we have to take money. Right? So the debtor could be a trade debtor, somebody who has purchased certain goods from us on credit and has not paid us, so he will become a debtor. We can have a loan debtor as well. Loan debtor is someone who has taken money from loan from us and has to repay it. Then we have sold a certain asset. I sold a machinery or I sold a furniture, and there's a debtor, for that. So that money is still due. Then service. So I rendered a certain service, and there is the amount which is still due. The person is not paid to me still. That is again a kind of a debtor. So I have four types of debtor: trade, loan, asset sold, and services. We will move next. Then again, when we talk about debtors, the debtors can be again categorized into three things. So there can be a trade debtor, loan debtor, asset, and service. And all these four kind of debtors can be classified into three categories. So I have a good debtor. Good debtor is one whom I am sure, who's doing good, and I'm pretty sure that he will pay me my money back soon. I'll receive it back. Bad debtor who is not repaying me my money back. I've tried my level best, but still I'm into efforts that fine he will give me, or he has a bad record, right? And doubtful is I have a doubt that the person might not pay his debt. So that's a doubtful debt which I have. Further, we have the next, again, as we had debtors, we'll have creditors. So the only thing changes within debtors and creditors is creditors are considered, or creditors are those whom we have to repay. Creditors are those persons, those category of people whom we have to pay, we have to repay. So let's say we bought goods on credit. So I have a company, my company bought goods on credit. So I have to repay it back. So if I have to repay it back, the person would be my creditor, whom I have to repay. If I've taken a certain loan from a bank, so I'm a creditor for a bank, right? So sorry, bank is my creditor. I have to repay them. If I bought certain asset and I've not paid for it, that's again a credit. Again makes me a creditor. So I again become a creditor for that. And then there are certain expenses, so for which I was supposed to pay, right? But I haven't paid it. So again, still I'm a creditor for that. Right? So I believe the rest of the part we can continue in the next class.
Professor, thank you for your session. It was informative. And apologize to the learner group for some glitches that happened. We will take care of it. I will just have some few questions, Professor, if you can help them to address it.
Please, sir.
So some of the very interesting questions was there. So I will take the most of the important ones. What is the substance over legal forms?
Substance over legal forms is something which we have not studied right now. It's related to the companies.
Okay.
So
we'll take it later, kind of thing, when we touch
yes,
upon it.
for sure. We'll have it later, but we have not discussed it right now, and I believe the rest of the people who they'll have some confusion with it.
Okay. I'll go to the next one. Objectives of financial accounting. If you can explain the top objectives of financial accounting.
Okay. See, the objectives of financial accounting we discussed, right? The first objective was to record the transactions, first of all.
Yeah.
Right. So the financial accounting was supposed to record the transactions. So how the transactions are happening, what I have done, that is recorded. Then it helps us in assessing the performance of an enterprise. So how my organization is doing. So that is the basic objectives. I'll put the two important objectives of financial accounting.
We have detailed it also in our learning material, which is present in the learning management system portal. So I request learners to go through the content, pre-class content. So all these are beautifully explained with examples. Professor, I will take the next question. What is liquidity? How it is useful in financial process?
Liquidity, if I say in normal terms or in basic terminology, liquidity is the ability of the company to repay its debt. How strong a company is in repaying its debt, that is liquidity. So in financial prospects, it's important because anybody who is giving money or anybody who is trading with the company would like to know what is the financial capacity, what is the liquidity position of this company, how good are they to repay, or what position are they in. So that's where the liquidity is important.
Yeah, then there's other viewpoint saying that still companies use Excel sheet. There are a lot of tools for maintaining the accounting process, so the companies can decide based on the volume. Professor, next, clarify between journal and ledger.
Sure. Journal is where we actually do the transactions. Let's say I bought since starting we had an example of furniture. So let's say I bought a furniture and I recorded, that's fine. I bought furniture for 50,000 rupees or 50,000 currency. So that is my journal. Now from this journal, I'll take it to the two different books. One is related to the furniture, other one is related to the cash. So that is my ledger accounts. So where I have individual accounts for all the headings, for all that what is involved, let's say furniture, cash, goods, stock, fixed assets, that is called ledger. Individual accounts for everything. But when I record these, the entry for all this in one particular book, that is called as journal.
Right. Next one is between internal and external users. With some example, Professor. Who are internal and who are external? With some examples.
Sure. Internal, as I told you, that internal are people who are the part of the organization, who are associated with the organization. So the managers, the workers who are their employees, they are the internal users. And when we talk about external are those users who are indirectly associated with the organization, but not are a part of that organization. So external, we talked about regulatory authorities. Now, what regulatory authorities have to do internally? Nothing. So that is external. Then what we have next is we talked about creditors, right? So creditors, they are the sellers to the business. But do they have anything to do? I mean, yes, they are related to the business, but they are external users. They are not insiders of the business. So that's
Right.
where the internal and external gets clarified.
Next one is whether government regulations or company policies what decide which type of book accounts to be maintained by the firm.
Yes, there are government policies and company accounts which follow, which the companies are supposed to follow, but still there in certain cases there are loopholes, or there's a discretion lies where the company can decide that fine, we can take this in spite of going for, let's say, uh, way one, we can go for another way out, and we can figure out the how we can take it further. So agree, there are government policies and rules and regulations, but still there are the choice. Still some of them have choices with them.
Right. Stage in bookkeeping is explained. I will go to the next one. How much percentage of depreciation has to be charged monthly, yearly? Who fixes this?
Great. Good question. See, we have the different countries have their accounting authorities, right? So, like in India, we have ICI, that is Institute of Chartered Accountants of India. Similarly, the whole world is moving on to IFRS, and then in US we have US GAAP. So that's how it works. So these are the authorities which decides that this would be the rates, and then there are income tax authorities again in the country which actually have a certain rates decided according to them. So that would be the rate. So there's a lot of scope of discussion onto this, but yes, there's a difference between what the income tax authorities suggest and what the accounting authorities suggest.
Right, Professor. Professor, we use terms called as investors, lenders, and creditors. So, how do we differentiate, quick differentiation between these three?
Investors are the one
Lenders
who
and
are
creditors.
sure. Investors are the one who are putting their money into the business. They're buying the stocks of the company. They're buying shares. They are trading onto the stock market. Let's say if today I buy some Reliance shares, that's an investment I have done. But when it comes to lenders they pay a certain amount of money to the company as a in one go. So let's say tomorrow IDBI banks or certain bank gives 500 crore rupees to a certain company. That's a lender. So at a fixed interest rate. So investor is the one who is buying your shares, who is investing into the company. The lender is giving you a whole amount at one go and will be charging interest for that. Investor is taking a risk that he might not get any return. His return may get zero. But lender is not taking that risk. Lender has a fixed rate of interest to charge. Similarly,
Right.
debtor, on the other ground, debtor is someone whom you have from whom you have to receive money. So let's say I have a business of laptops and I sold a laptop on credit. Now I have to receive that money. So that is the person who has purchased the laptop will be my debtor. Similarly, on the right opposite to it, I have creditors whom I have to pay. So if I have purchased the laptop, so I am a creditor. So that differs. So if you sell, there's a debtor. If you purchase, there's a creditor. That happens. I hope it answers.
Yeah, perfect, Professor. Professor, there's a viewpoint. Accounting is based on monetary value. So, how is it not free from bias? How is it not free from bias?
See, there are, as we discussed, there are certain judgmental decisions which needs to be taken. So I can decide, that what can be on those particular grounds. I can decide that what needs to be included, what not. Let's say I have an inventory which I am not able to sold from last 1 year. Now the discretion lies with me that will I show it as an obsolete inventory and write it off, or will I not write it off? I'll include it in my inventory. I have receivables who have not paid me from last 6 months. I am continuously following them. So am I supposed to write them off right now, or will I still include them in my receivables? So there are ways, there are people they figure it out. So that's why there's a biasness involved. People put their mind into the decisions. It's
That's
not
right.
rational
Yeah.
research.
Professor, we also spoke about window dressing in financial accounting.
Serve it.
It may not be illegal, but is it ethical? What are the legal consequences of window dressing?
Yes, legal but not ethical, suggestively. So that's where your ethics comes into role. The consequences are stringent. The company who is auditing might get barred out if they figure out. The investors might lose interest. There might be, the society might lose trust into that organization. So the repercussions could be very hard, but yes, it's legal but not ethical.
Right, but more risk is there for the organization and its investors. Okay. Then what is the difference between inventory valuation method and receivables management?
When we talk about receive inventory is something which is related to the stock what we are dealing with. So if I have a medical shop, the medicines what I have, that is my inventory. So I need to take care of my inventory and what method do I apply for valuation. So that is my inventory valuation method. When it comes to receivables are the people whom I have sold on credit, from whom I have to take my money, still I need to receive my money.
Yeah.
That is receivables management. So I have different policies for receivables management and different policies for inventory valuation, and that's
Right.
where they do differ.
The next one is, what is the broad differentiation? How do you define financial and management accounting? What is financial accounting and management accounting? A broad categorization at the top level.
See, financial accounting as a field is most if you'll see, its focuses on reporting aspect, how to present, how to show, what needs to be shown, and it is actually regulated and controlled by the authorities of the country. So let's say the accountancy authorities and all those things. But when it comes to management accounting is altogether a very internal part of the organization. The outsider has nothing to do with management accounting. It's all internal, and there is no rules and regulations which actually covers management accounting. So it's like what I management accounting is a part of management's choice. They can figure out, they can do anything what they want with the data and come out with their conclusions, and it's totally internal. But financial is external and it is controlled and regulated by the authorities.
That's right. Professor, now given the situation in the country, the economic situation, so everybody realizes there are some debtors who are not going to pay back. They become bad debts over a period of time. So is it okay? How can we show them under receivables? Is it for the purpose of window dressing of the organization, or is it good to write off?
I'll put it like this, still, if you look onto the banks right now, the banks are still struggling to figure out, that whatever money they have floated into the market, how much of that money they will able to get back. But by the time the person is paying, they cannot write it off. They cannot go with for the write off. So the
Okay.
same thing applies on the business as well. If by the time the person is paying, I have the probability, I have the chances that the money will come. I cannot write it off. But yes, with due time, if the person starts doing default and if he doesn't repay, I have no other option except to write off and book a loss. That's all I can do.
What are the effects of writing off? Means what exactly happens after that?
Writing off actually reduces my losses. Oh, sorry, my profits. So
Right.
the straight away impact of writing off is on my profit. So I'm booking a loss. So the moment I book a loss, my profit gets hit. So my profit gets reduces by that amount.
Right, Professor. There's again one more question on difference between current and liquid assets.
And sorry to add more into the previous question. If again the write-off depends on the provisions what I have made. So if I have sufficient provisions, it will not hit my profits as such because I'll settle down the write-off from my provisions. But the problem comes when the write-off exceeds my provisions which I have made for the losses.
Yeah.
So if that exceeds, it will straight away hit my profits.
Right, Professor. The next one is on I just spoke about current and liquid assets. How do we differentiate?
When we talk about current assets, I told you the three categories to decide that whether the asset is a current asset or not. The first one was that it is cash in hand or cash at bank. Next one was it is convertible to cash within an year or an operating cycle, whichever is longer. And the last one was it is consumed in the operations of business. Now this is falls for the current assets. When we talk about liquid assets are more stringent measure than current assets, and which is like convertible to cash or in a very short, we can say, future or very short period. So like cash in hand, cash in bank, that comes into the liquid assets. And then we have, cash equivalents, that comes into that. So what we do actually, when we come to when we have to differentiate between current assets and liquid assets, we remove two categories of assets from current assets. The first one is stock, and the other one is prepaid expenses. Because you never know when you will go for sell, when you will be in crisis and you go for selling your stock, what value you will get for that stock. And similarly, second thing, your prepaid expenses are something which get, you can actually benefit, which gives the benefit with time only. So if I have paid an insurance for next year, I cannot get benefit of that insurance this year, and I cannot even ask for the insurance company to refund my amount.
Yeah.
So that is why we remove two assets, stock and prepaid expenses, from current assets to come up to the liquid assets.
Right, Professor. Just a couple of more questions. The broad difference between stock and share.
I'll say when it comes to the investment terminology, yes, stock and share is one and the same thing. But when it comes to business terminology, when I say stock or share, they are two things apart. So there are some things, some terminologies which are overlapping and which creates confusion. So stock I can use for the share as well, and stock I can use for my inventory as well. So, but that's where we have to keep our, we have to figure out related to the term relevance of the circumstances where we are using a particular term. So I can use stock and share for the share as well, but I cannot use share for the inventory. That is very clear. But stock has got some confusing terms with shares. So shares and stocks, that is being considered as synonymous at times. So we need to apply our discretion that at what circumstances and where we are applying it.
Yeah, thanks, Professor. One more question. What do you mean by off the book accounting? Off the book accounting.
So can you come up again, please?
Off the book accounting, OFF, off the book accounting. What do you mean by that exactly?
Okay, off the book accounting is something like where we have off balance sheet items which come in. So off balance sheet or off the book accounting is those items which are not recorded in balance sheet but still they exist into the business. So that is what we call. So we have kind of an off balance sheet financing as well, where we include factoring and all those things. So that happens. So that is something which goes to the advanced level of accounting, which we should. I mean, the first class, I believe, it's too much for that to discuss right now.
Okay, there are some basic questions out there which you have answered in our the brief content what we have in the LMS. I am skipping that. Three golden rules of accounting, Professor. What are the three golden rules? Anything on top of the mind?
Yes, there are three golden rules of accounting, but that's the debit the receiver, credit the giver, debit what comes in, credit what goes out, debit all expenses and losses, credit all incomes and gains. These all are golden rules of accounting, but these rules are actually it's depends on the learner, how he learns. So you want to learn through cramming up these three rules, or you want to have an understanding of the concept and just on the applying that concept you can learn. So yes, there are these three rules what I told, but again, some people learn accounting by using these rules. Some people learn accounting by applying concepts or understanding concepts. So that's depends on the user actually.
Yes, so sir, towards the end we are coming. What is contingent liability with an example? Contingent liability.
Sure. Contingent liability is, I'll say, a liability which cannot be classified as a liability. So it can occur or it may not occur in future. So the basic definition says that contingent liability is a liability which depends on the happening or non-happening of a certain event. Right. So if that event happened, I have to pay if I have to pay that money. If it doesn't happen, I don't have to pay money. It's like, let's take a simple example. There's a lawsuit going against a company. So and there's a certain claim. So if the company loses that lawsuit, they have to pay that claim. That will be their liability. But if they don't have that, they win that lawsuit, they don't have to pay it. So that's what the contingent liability is.
Okay, Professor.
I hope that answers.
Yeah. Definitely. There's one hypothetical question. What happens if we get the money after it is written off? Hypothetical.
No, it's not. It's a real scenario. It's not hypothetical. I mean, let's be very clear. Yes, we do get. It happens. We write off and we get it back. So there are options for that as well. We write them as recovered. So we have, if it is loan recovered, we write it loan recovered, and we do bring it back into our books. So again, the write off what we have done, we cancel that. So it happens. Yes, it's a common scenario which happens in businesses.
Right, Professor. What do you mean by historical cost?
Historical cost is like any cost which I have incurred when I bought that particular asset. So let's say I bought a machinery 5 years back, and that machinery was, let's say, 50 lakh, right? So that machine, so I'll record that machinery for 50 lakh in my books on that day, and that will continue as 50 lakh. So that is historical cost. So the money which I have, which has been recorded in past, or the amount which has been recorded in past, and that continues, that is historical cost.
Right. Almost all the important questions are taken care. Thank you, Professor. Thank you for the informative session. And once again, I apologize for the technical glitch. Just to the learners, we have covered all the things in detail in our e-content under the unit. Please go through it as a pre-class reading material. It will help you a lot in understanding all the basic terms. It's given with examples. Also with the reference books are given there. You can refer to them. And there are a lot of good video tutorials are available. Then there is also Coursera links available for this course. Kindly go through them. It will be very informative for all. There will be model question papers provided. You can just understand what kind of questions will come. Exam will be with complete flexibility. It is going to be 100% online, right? And assignments will be made available by end of this month, and there will be sufficient time to answer those assignments. There will be 2 assignment questions, right? The today's lecture recording will be made available over the week before the next class. We will again connect over the next class. So I once again thank Professor for this session, and have a nice weekend to all. We'll again get connected over the next weekend for our resuming our classes. So have a nice weekend, and we will connect again. Thank you. Professor, with your kind permission and information to participants, I am ending this session. Thanks everybody for attending this session.
Thanks a lot, sir. Thank you. Thank you, all of you.
Yeah, and most of the questions you can also use discussion board in the learning management system, which will get answered by the professor at a later point of time. Be connected with us through the learning management system. Thank you, everyone. So with this, we complete the session. Attendance will be captured by default by the system. Those who attended the session completely, their attendance are captured, so nothing to worry about the attendance part. Right? And more engagement over the learning management system, the portal, which is very important for the learning perspective. Thank you. I'm ending the session, Professor. Thanks.
Thank you, sir. Thanks a lot.